And more now about that speech by new Fed Chair Janet Yellen. In a major address to the Economic Club of New York, Yellen said that interest rates will stay extremely low for a, quote, considerable time. Yellen basically said the Fed is trying to thread the needle. That is, get inflation up closer to its target of 2% and get unemployment down closer to its target of full employment. That is, between 5.2 and 5.6%. That, she thinks, could take a couple of years and will require a generally accommodative monetary policy. Steve Leisman puts it all together for us.
Good evening. New Fed Chair Janet Yellen, in a major speech today before economists in New York, suggested it could take as long as 2 years before the economy meets the Federal Reserve's goals.
It's a sign of how far the economy has come that a return to full employment is, for the first time since the crisis, in the medium-term outlooks of many forecasters. It is a reminder of how far we have to go, that this long-awaited outcome is projected to be more than 2 years away.
The Fed sees full employment as between 5.2% and 5.6%. It's currently at 6.7%, and Yellen says that shortfall is significant enough that she suggested the Fed will keep trying to help the economy as long as the goal is not being met. Overall, Yellen made clear she was in no hurry to change the Fed's current policy of slowly winding down its bond purchases and keeping short-term interest rates low for an extended period. In fact, she's more worried about inflation being too low rather than too high.
With inflation running at around 1%, at this point, as I mentioned, I think the risk is greater that we should be worrying about inflation undershooting our goal and getting inflation back up to 2%.
Meanwhile, two Federal Reserve reports today suggested the economy is rebounding from the effects of the harsh winter weather. The Fed's Beige Book, a collection of economic anecdotes from the Fed's 12 districts, said consumer spending and manufacturing had both picked up as severe weather has receded. The Fed's report on industrial production in March came in well above Wall Street estimates, and February was revised higher as well. Only housing data disappointed, but not by very much. So the economic data continues to support the idea of a spring snapback, and the Fed chair suggests she's in no rush to raise rates and slow the economy down. For Nightly Business Report, I'm Steve Leisman.
Nariman Baravish joins us now with his analysis of the Fed and the economy. He's chief economist at IHS. So, Nariman, I thought that in her speech, in Janet Yellen's speech, that the best part actually was in the Q&A where she was pinned down about, is she going to fall behind the curve? Is she going to control inflation? And she seemed to give some very comforting answer that, no, the Fed's going to do the right thing when it comes to raising interest rates at the right time. What was your take on that? And did you find it reassuring or still worrisome?
No, I think it was very reassuring, and I think she got the message right this time compared with a month ago when she was speaking perhaps a little on an impromptu basis and spooked the markets. But this time around, clearly, she was on message, and I think she was very clear. She was upbeat about the economy, and yet she was dovish on monetary policy, essentially saying, as you said, we're in no hurry to raise rates, and that's the right policy at this point. We're still a ways away, as she said, from full employment. And so until we get there, and until inflation shows signs of life, which it hasn't, no reason to raise rates.
I was curious as I listened to her today, and she said we're probably 2 years away from full employment, which suggests an accommodative monetary policy until then. How did we get from 6 months from the end of QE to 2 years in 1 month's time?
Yeah, I agree with you. I think I'm not quite sure what was on her mind when she said that. Maybe she kind of felt trapped or something, or she just clearly misspoke. But I think our view is that the earliest the Fed's going to raise rates, QE we think will be over by the end of this year. But in terms of raising rates, our view is the earliest is probably mid-2015, and that's very consistent with what she said today.
And so what is your take on how the economy is doing, your own views and also what she was saying? Yellen was talking a lot about the job market. She seemed very upbeat that things are moving in the right direction. Is that how you see it? And just generally, what's your view on the economy?
Well, first things first, the first quarter was badly affected by the weather. And when we get the first GDP numbers for the first quarter, which will be at the end of this month, it'll show a very weak quarter, less than 1%. We think 0.9%. But that misreads the economy because the underlying growth rate is more like 2.5% to 3%, which I think is sort of consistent with what she's saying. And we're actually seeing that coming back in the second quarter. You mentioned the industrial, or Steve mentioned the industrial production numbers, the Beige Book. We've had the employment numbers starting to look better. So I think the answer is fairly clear. Bad weather hurt the first quarter, but by the second quarter, we're back to that sort of underlying growth of about 2.5%.
We're going to talk a little bit more about China's growth in just a moment. But if you broaden out your prism from the U.S. economy, how do you see the global economy right now?
Well, ironically, it's the developed economies, the advanced economies, that are doing better than the emerging world. They're actually contributing to growth. You've got the U.S. picking up this year, Europe going from a negative to a positive this year, Japan doing okay. Whereas a lot of the emerging markets, growth has fallen quite a bit in the last few years and probably will continue to disappoint this year. Brazil less than 2%. Russia probably in recession. India, okay, doing a little bit better, but maybe half the growth rate of 2 or 3 years ago. So very disappointing.
All right. Nariman, thanks as always for giving us such good analysis. We appreciate it. Nariman Baravish with IH.